Have you ever noticed that one announcement from the Federal Reserve can make your savings account earn more money, your mortgage become more expensive, and your credit card debt suddenly hurt a lot more? That's exactly what happens every time the Fed meets. And with the next Federal Reserve meeting approaching, millions of Americans are asking the same question. Should I be doing something with my money right now? Today, we're covering 3 smart money moves you should consider before the Fed's next decision. Then we'll tackle one of the biggest financial debates for young Americans. If you have about $1,000 per month to spend on housing, are you better off renting or buying in 2026? The answer might surprise you. Let's get started. Section 1. What the Fed actually does. Before we talk strategy, let's quickly understand what the Fed controls. The Federal Reserve doesn't directly set mortgage rates. It doesn't directly set rent prices. And it doesn't directly control your credit card. Instead, it sets a benchmark interest rate that influences borrowing costs across the entire economy. Think of the Fed as America's financial thermostat. When inflation gets too hot, the Fed raises rates. When the economy slows down too much, the Fed lowers rates. Those decisions ripple through banks, lenders, businesses, and eventually your wallet. That's why every Fed meeting matters, even if you don't invest a single dollar in the stock market. Section 2. Money Move. Maximize your savings account. Let's start with the easiest win, your savings account. Many Americans still keep their emergency funds in traditional bank accounts, earning almost nothing. Meanwhile, high-yield savings accounts are paying significantly more. And here's why the Fed matters. When interest rates rise, banks generally increase yields on savings products. When rates fall, those yields usually decline. That means if the Fed signals future rate cuts, today's higher savings rates may not last forever. So what should you do? First, check what your savings account is currently paying. If you're earning less than 1%, you may be leaving hundreds of dollars on the table each year. Imagine having $20,000 in savings. At 0.1%, you'd earn only about $20 annually. At 4%, you'd earn roughly $800. That's a massive difference for doing absolutely nothing. Second, build an emergency fund before chasing risky investments. A strong cash cushion gives you flexibility regardless of what the Fed decides. Third, avoid locking all your cash into long-term investments if you might need the money soon. Liquidity matters, especially during uncertain economic periods. Your first money move. Make sure your savings are actually working for you. Section 3. Money Move number 2. Review your credit card debt. Now let's talk about something that can quietly destroy wealth. Credit card debt. Here's the uncomfortable truth. Credit card interest rates are heavily influenced by Fed policy. When the Fed raises rates, credit card APRs often rise too. And many Americans are carrying balances month after month. Imagine owing $10,000 on a card with a 25% APR. You could end up paying thousands in interest before eliminating the debt. That's money that could have gone toward investing, saving, or buying a home. So before the next Fed meeting, ask yourself, what's my current credit card balance? What's my APR? How long would it take me to pay this off? Then create a plan. Maybe it's a balance transfer. Maybe it's a debt avalanche strategy. Maybe it's simply making larger payments. The goal is simple. Reduce high-interest debt before interest costs consume more of your income. Because earning 5% in a savings account means very little if you're paying 25% on credit cards. Section 4. Money Move. Check your mortgage strategy. Now let's discuss mortgages. Mortgage rates don't move exactly with Fed rates, but they're definitely influenced by expectations around inflation and future Fed decisions. That means even before the Fed announces anything, mortgage rates can move. If you're planning to buy a home within the next year, this matters. A small change in mortgage rates can dramatically impact monthly payments. Let's look at a simple example. A $350,000 mortgage at 6% versus 7%. That 1 percentage point difference can add hundreds of dollars to your monthly payment. Over 30 years, the difference can reach tens of thousands of dollars. So what's the smart move? Know your credit score. Reduce existing debt. Improve your debt-to-income ratio. And shop around for lenders. Many buyers focus only on home prices. But financing costs can be just as important. The stronger your financial profile, the more options you'll have regardless of what happens at the next Fed meeting. Section 5. $1,000 per month. rent or buy in 2026? Now let's tackle the question many young Americans are asking. If you have roughly $1,000 per month available for housing, should you rent or buy? The answer depends heavily on where you live. Let's compare. In expensive cities like New York, Los Angeles, or San Francisco, $1,000 per month usually won't cover ownership costs for a typical home. Renting may offer more flexibility and lower upfront costs. But in smaller cities and affordable markets, buying becomes more realistic. Consider a modest home priced around $180,000 to $220,000. With a down payment, mortgage payment, property taxes, insurance, and maintenance, monthly ownership costs could potentially land near that range. But ownership comes with responsibilities: repairs, maintenance, property taxes, unexpected expenses. Renters avoid many of those costs. Homeowners build equity over time. Neither option is automatically better. Here's a simple framework. Rent if you might move within 5 years. You need flexibility. You don't have a strong emergency fund. You don't have money for a down payment. Buy if you plan to stay long-term. You have stable income. You have emergency savings. You can comfortably afford maintenance costs. The biggest mistake isn't renting. The biggest mistake isn't buying. The biggest mistake is stretching your budget so far that housing controls your entire financial life. As we head toward the next Fed meeting, remember these 3 money moves. Number 1, make sure your savings account is earning a competitive rate. Number 2, attack high-interest credit card debt aggressively. Number 3, review your mortgage or home buying strategy before rates change again. And when it comes to renting versus buying in 2026, focus less on what everyone else is doing and more on what fits your financial situation. Because personal finance is exactly that, personal. If you found this helpful, hit the like button, subscribe to the channel, and let us know in the comments. Are you renting, buying, or waiting for rates to fall? Thanks for watching, and we'll see you in the next video.